You said you have your lowest exposure to credit in 40 years. The kind of only other times you've been underweight are the Lehman crisis and right before COVID. So what does that mean practically for your investments? Does that mean that you're completely getting away from credit? Are you in investment grade but still at the lowest level? Are you moving into high yield? What does that exactly mean?
Sure. First of all, if you look at the investment grade universe, according to the index, it's almost $30 trillion. The corporate bond market makes up about 25% of that, or roughly $8 trillion. So if you look at our portfolios, to be a market weight would be roughly 25% of our portfolio. Frank, we're carrying less than 10%. We're right at 5%. And the reason is, you've already said it to our viewers, is spreads are so narrow. In fact, we are at or near the narrowest levels ever. And so there's really only two directions that corporate bonds can go, either sideways or much wider. The average is almost double where spreads are today.
All right, so Gilbert, I want to dig into this. When you say you're at 5% corporate bonds, you're talking about investment grade, right? So what about high yield?
That is correct. We don't buy high yields, but just know that the high yield market is generally the same. It's just as tight. If you look, the high yield average right now is about 100 basis points wider than the roughly 280 where it is today. So no matter how you slice it, whether it's high yield, high grade, or even things outside, whether it's CNBC or other markets that are in the fixed income world, they're all at very tight spreads.
All right, so isn't part of the issue that a lot of corporate bonds were issued in the first half of the year, or not an issue, but there's an opportunity there because a lot of corporate bonds were issued in the first half of the year. Won't that create some scarcity in the back half of the year that should improve the outlook?
Sure. If you look at the corporate bond market, the average supply is almost $400 billion a year. And we're right about 80% of that already. So in reality, Frank, we're already at very robust levels of supply just for this year. So what does that mean? What it really means is everyone is in the same trade. Buy as much credit as you can have and hope that nothing goes wrong. And that's just not a good strategy. If you look historically, it tells you that's a losing strategy.
Okay. So we continue to spell out this problem, Gilbert. So what's the answer? Is the answer to stay away from credit? And if so, until when? When do you see the inflection point that makes credit more attractive?
Sure. One of the first things is the average over the whole time that we have had the index and the data, which goes back to roughly 1990, is roughly double where spreads are today. So spreads are right now roughly 74 basis points over treasuries. You're talking about an average of about 150. So you've got to get at least close to that average, somewhere in that low 100s, like 125 to 150, before they even begin to make sense. In our view, we're going to find that there will be greater opportunities down the road, and that's what we're waiting for. So we are trading credit risk for mortgage-backed security prepayment risk today.